viewers, welcome back to my YouTube channel. So today we are on the website of morningstar.com, and on this website we have a blog to read about 7 market trends from Q3 2023, right, from 2023. Let's see how it goes. Equity markets cooled in the third quarter of 2023 after a strong start to the year. The mega gap growth stocks that fueled the first half rally receded as investors absorbed the impacts of a higher for longer interest rate scenario, even following a 3.3% drop for the quarter. The S&P 500 still closed September up more than 13% this year. What fixed income investors gained in yield, they lost in price during the third quarter. Income conscious investors were pleased by their increased payouts but less pleased with the 3.2% price decline across US investment grade bonds. High yield bonds were largely spared by this contraction, though breaking even on the quarter and preserving their 6% gain on the year. Commodities were also one of the few bright spots this quarter, which was marred by losses across most major asset classes. The Bloomberg Commodity Index was up nearly by 5%, driven by rising oil prices following production cuts by OPEC plus producers. The United States was not only the market caught in the crosshairs, just like at home, foreign investors mulled the possibility of higher rates for longer to combat stubbornly high inflation. Most major international markets fell in the third quarter despite posting strong returns to begin the year. Developed market stocks were hit particularly hard. The MSCI EAFE index fell more than 4% in the quarter. Every quarter, Morningstar's research team reviews the most recent US market trends and evaluates the performance of individual asset class. Then we share our findings in the Morningstar's Markets Observer, a publication that draws on careful research and market insight. Morningstar Direct and Office clients can download the report here. Here are some of the findings from our latest quarterly market review. So this is the most recent article given by them. Treasury yield curve bucks the historical norm. The Treasury curve bears steepened over the quarter as long rates moved higher, while short rates remained anchored. This is unusual. Historically, as the Fed moves closer to the end of rate hiking cycle, both short and long rates move down, with short rates falling faster, a bull steepening. However, continued inflation, volatility, a resilient domestic economy, and pressure from increased treasury issuance challenged conventional wisdom. Now, US lease curve and the third quarter with less intervention, you can see over there. Now, interest rates may dip below 3% by 2025. It's a prediction. How our forecasts for path of the federal funds rate are well below market expectations, growing into a nearly 2% point gap by the end of 2025. Our optimism about inflation coming down is a key reason that we expect interest rates to fall faster than the market. Also, we disagree with the emerging view that the neutral rate of interest has jumped compared with its pre-pandemic level. Credit risks not needed to earn an attractive yield. Yields continue to climb as the Federal Reserve reinforcement or reinforced higher for longer messaging in order to tame inflation. Bond prices have been crushed since early 2022, but higher yields may present attractive opportunities, especially in less risky, higher quality bonds like treasuries or agency mortgage backed bonds. This backdrop allows investors to pare back credit risk while improving income potential, a luxury they have not had in a long time. Developed markets stock remain on top. Developed markets stock remain 12 months winner even with third quarter losses as equities rebounded from October 2022 loss. Emerging markets equities have rallied though Chinese stock market weakness dragged on the index. Commodities stormed back in the third quarter as oil rebounded but did not offset a 9.4% drop from October 2022 to June 2023. US bonds have recovered from loss but still struggle in a higher interest rate environment. So thank you so much for coming up to the end of this video. See you soon in the next one. Before that, subscribe my channel, press the bell icon for more updates. Bye bye. Take care.